Hello and welcome to Morning Markets of Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada's economy shed the most jobs last month in 4 years. Data from StatsCan shows the labor market lost 84,000 jobs in February. Economists were expecting an addition of 10,000. Jobs were mostly lost in the goods and services producing industries, with 18,000 jobs disappearing in wholesale and retail trade. Meanwhile, the unemployment rate edged higher to 6.7%. Data signals continued softness in the labor market. China says it will impose anti-dumping tariffs on certain rubber products from Canada and Japan, with the new levies taking effect tomorrow and remaining in place for 5 years. According to China's Ministry of Commerce, tariff rates will be a little more than 30% for most Japanese companies, 14% for Canadian producers. Shares of Enghouse Systems are taking a hit. They're off more than 12%. The software company reporting lower profit and revenue in its latest quarter, with both missing estimates. Enghouse says it is dealing with ongoing economic shifts, changing predictions regarding AI, and an increasingly unpredictable global environment. On the upside, the company raised its dividend by 3%. And looking at the markets, with the turn from the start of the day, you can see the TSX off by 0.4%, continuing that downward trend. And let's take a look at the U.S. market, see where they stand right now. And it is a mixed bag. See the S&P 500 off, the Dow about a wash right now on the plus side, but not by much. And the NASDAQ now off by 0.44%. Well, stock markets did steady this morning. Then, as you can see, they took a little bit of a turn as oil pricing eased and investors wait to see whether the war in the Middle East will escalate. Our next guest says that Canada's markets are more insulated than most, given the weight of our energy sector. However, he says that will mean little to consumers, who will have to deal with higher prices as a result of the conflict. Joining us now is Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. And Kyle, thanks very much for joining us.
Thank you.
It is a difficult balance right now. There is some opportunities, but also overall, consumer-wise, we're going to be paying for a lot of this stuff. How are you approaching what is unfolding right now?
Well, I was going to say that at least winter's over, but I look at my window and, and here in the GTA, we've got some snow. It's certainly a mixed bag. From the TSX perspective. Having such an energy weight has been a bit of an insulator for Canadian investors. But from the consumer perspective and the business perspective, obviously there are associated rising expenses with that. What I would say, though, from the business perspective is that even though we've seen this thus far sustained growth in the price of oil, businesses are unusually strong, even though some of the headlines appear to be quite negative, right? So global earnings growth in not just Canada, the US, but internationally is exceptionally strong, and is at a level that really you don't see very often outside of post-recession recoveries or major economic booms. And then there's a few other elements as well. We mentioned the consumer spending on energy-related products as a percent of total disposable income has actually trended down over the past several decades. And finally, there's been an ongoing trend decline in energy intensity and the number of barrels needed to produce each dollar of global GDP. So I think it is an interesting environment for investors. It's not entirely a surprise that equities are especially sensitive to a shock, just given how we started the year and equities largely being priced to perfect. Really, this year it's been about who played the best defense and who was able to, maybe have already rebalanced their portfolios away from some of the more expensive areas of the market towards some of those value and quality and dividend names.
Well, they say defense wins championships. Can I throw in the soft jobs numbers too, just to stir it up a little more?
Yeah, absolutely. I mean, I think there's a lot of a cloud of uncertainty that is overhanging on the Canadian economy, and it's something that's been talked about a lot. And kind of a weakening labor market is certainly not helping anything. And as we move into the summer with the review of CUSMA, Really, I think as long as energy markets continue on, then who knows what the TSX can do. But from a broader perspective, I think most investors would like to see some of these issues dissipate, so we can move back to hopefully the long-term trend moving forward.
And so, how are you playing defense right now?
Well, I think for us, it was all about how we entered the year and having rotated or made sure that our portfolio was built for resilience. I think the message for me today is the fact that my job is to help clients and Canadians navigate the uncertainty, but also make clear that we're doing so with a portfolio that was already built for that uncertainty. And once that the shock of the day and the volatility currently gripping investors' minds dissipates, then it's an opportunity where you can look back as value having being added to investment portfolios. I think one of the interesting things for us today is the fact actually in the software and in the tech space, as you know, the first couple of months were quite brutal in terms of AI disruption, concerns around AI monetization, and then the associated disruption for a lot of the software stocks. Interestingly, a lot of the software stocks are starting to meet our pretty rigorous screens for investment, which shows us that valuations have come down and there might be a bit of an entry point forming. And interestingly, these last couple of weeks, it's actually been a lot of support for portfolios, whereas a lot of other areas of investment portfolios have declined.
And just looking at your notes about the Deutsche Bank noticing that, noting that historically when oil shocks hit, U.S. stock markets will drop more than 15% when there's one of these three circumstances: a 50 to 100% oil price spike. We're not over several months yet, but who knows? A slow-moving economy, some of the numbers that we just saw, and a sharp hawkish pivot from the Fed to fight U.S. inflation or fight inflation. We have a potential for all three, don't we, right now?
We do. I mean, one of the interesting things for me is I think a lot of us were doing our sort of refresh on what took place in the 1970s with the OPEC oil embargo, and I know people are a bit afraid of the stagflation mantra, but in terms of what one of the key things that helped get the U.S. economy and the global economy through that in particular was the fact that it was Fed credibility, U.S. Fed credibility. And of course, that's something that is come into question in recent months. And with the new Fed chairman, I think that there will be an onus, assuming this is still going on the Fed to really make clear that independence and maintain that element of credibility in order to help markets push forward. But really, I think the big question was first around the sustained oil price spike. That really will carry what the news are and what the markets are going to do. We've already seen the past couple of weeks around the inverse relationship between the price of oil and stocks. And really, I think that'll be something that investors are going to be continuing to be keenly aware of moving forward.
All right, I want to get to a couple of notable stocks you're following. OpenText.
Yeah, OpenText was a recent addition. I mentioned some of the software opportunities there. OpenText is a well-known Canadian company. You can see the chart there with the recent declines. It's a recent addition for us as the valuation became really too compelling for us to pass up at a forward earnings of 5 times. And to me, it isn't as simple as hardware wins, software loses has been sort of the driver of some of these negative returns in software stocks these past couple of months. As companies continue to invest in AI adoption, I think it could actually be a benefit to a business like OpenText and others in the space. They have a really solid acquisition integration strategy, pretty good margin profile. What sets this stock apart from many peers in the space is actually a nearly 5% dividend. So we look at this as a good company that we're getting paid to wait for sentiment, for AI monetization and integration to really drive the stock higher.
All right, we're just about out of time, but I want to sneak in Canada Packers here before we go. What do you like about that?
Canada Packers, I mean, we've owned Maple Leaf Foods for a long time. It's been a fantastic company for us. Canada Packers, of course, is the result of a spinoff last year of their pork business. We think that we look at this stock and it's kind of a pure play pork stock. Really good fundamentals behind it. It's 4.6% dividends, and the lower valuation relative to peers is likely due to their shorter tenure as a standalone company and a smaller footprint. But as they sort of get that track record behind themselves, I think that'll be a catalyst for further analyst coverage and could reward investors for investing in them today.
Okay, we got to wrap it up there, but Kyle, thanks very much for joining us. Have a great weekend.
Thank you.
Kyle Taylor is Wealth Advisor and Portfolio Manager at Tri-Delta Private Wealth. Coming up, in February, the Canadian economy lost the most jobs in more than 4 years. We'll break that down after the break. Last month, Canada lost the most jobs in more than 4 years, while the unemployment rate ticked up to 6.7%. Our next guest says the weak February data is likely the result of unusually strong numbers at the end of 2025, but adds that the overall employment trend is still declining. Let's get more from Veronica Clark, U.S. and Canadian economist at Citi Research. Veronica, thanks very much for joining us.
Yeah, good morning. Thanks for having me.
Okay, so a good end of 2025 is meaning a bad start to 2026. Why the correlation?
Yeah, I think these numbers are very volatile month to month. I think you have to look at averages over many months to get a sense of the trend. We also do know that population growth has been slowing a lot this year. I wonder if that is just creating abnormal shifts month to month in usual employment trends. Of course, these monthly numbers are always adjusted for usual seasonal trends. There could be something off there. But yeah, we had some very strong months of job growth back from September through November. But employment should be slowing if the population is slowing. So I think this is probably just reflecting some makeup of that. But that being said, this is a labor market that is probably weakening. And I think the best evidence of that is the unemployment rate that is staying high.
All right. And you guys, I mean, you were closer to it than a lot of people. Everybody was saying 10K jobs. You guys were saying going to lose 10K or 20K. And actually, we lost 84,000 jobs. Where was the biggest loss? Where was the surprise part for this?
Yeah, I think the most concerning and the biggest surprise, because even though we were expecting employment to fall, we were not expecting such a large decline. But was in that full-time employment, that's generally more stable employment. It was also private sector jobs, so full-time private sector jobs. That should be the more stable, durable trend of employment. So to see that weak is probably a pretty concerning sign for the Bank of Canada. Yeah.
And from region to region across the country, there were a couple of places that took bigger hits than others?
Yeah, I mean, you'll always see, differences across, different regions, and we never quite know, what happens in one region versus another. Of course, you'll always see that, dispersion among sectors also. But yeah, if you average through all that volatility, of course, even in just the general monthly numbers, it does seem like the trend of employment is weakening.
And any clear indicators as to reasons behind it? I mean, is it CUSMA again? Are there other factors that are coming into this now?
Yeah, we never quite know. And again, how I mentioned the shifts in population, such large shifts in such a short amount of time. We've seen the population slowing substantially over the last year. Can always just create weird seasonal dynamics. If you look at the non-seasonally adjusted February data, employment only declined by about 12,000. So was this just less hiring in February than we're used to? It could be dynamics like that. Maybe there's some weather effects. But you don't want to just dismiss the weakness every month and averaging through those months. If the trend is lower, then that is a weakening labor market.
All right, and this is one more data point for the Bank of Canada with a decision next week. What are we looking at, do you think?
Yeah, it is an interesting place for them to be going into this March decision, because since they last met, a couple months ago, we have the 3-month pace of core inflation that's at just 1.2% right now. Obviously much weaker employment data than we had a couple months ago. If anything, it looks like the Q1, GDP forecast for the BOC is maybe a bit on the higher end. We're tracking a bit softer than that. I actually do wonder if this could have been, the start of the bank maybe rethinking the potential for rate cuts, or at least more clearly signaling that, there's a lot of uncertainty, but the risks are building to the downside more than they thought. But now you do have this added complication of oil prices moving higher. That would keep them cautious. This is a negative, inflationary supply shock. But for now, I think they'll just stay in this wait and see mode. But if anything, core inflation sub target would be telling you that maybe you need a bit more monetary accommodation. But we'll see how the oil shock evolves.
All right, and oil's the big thing for now, isn't it? It's what everybody's following. It's what I imagine the bank is following too.
Yeah, it's the big unknown, and it's just, too short of a time to really know how this will impact activity. Obviously, Canada is an oil producer, and so the growth effects are not so clearly negative, but higher retail gas prices, that's going to weigh on consumer spending, sectors outside of the energy sector, of course. But it is inflationary. Gas prices will be going higher, but if that weighs on demand in other sectors, then the net effects are not always clear, and it's just too soon to know.
Okay, so it's Friday. Let's end. Is there any positive from this report?
Yeah, and I mean the best positive I would say is that the unemployment rate is still off the highs, right? We saw the unemployment rate a bit above 7% really end of the summer last year. So there has been some improvement in that supply demand balance, but not a substantial improvement. And given that we've seen labor supply slowing, as much as it has with slowing population, that unemployment rate staying close to the highs is still telling you that demand has weakened alongside that.
Okay, and when you break down and start looking at the trends, which way does it feel like we're trending right now?
Still feels like the employment trend is lower, and I would be worried about some surprises to the upside for unemployment at some point. We've had this really sharp decline in labor force participation. If we see that come back at all in the summer, maybe that could mean upside risk for the unemployment rate.
Okay, we'll wrap it up there, Veronica. Thanks very much for joining us.
Yeah, thank you for having me.
Veronica Clark is the U.S. and Canadian economist at Citi Research. Coming up, today's market drivers with Bloomberg's Monique Molina. Time to take a look at today's market movers. We're joined on that by Bloomberg Equities reporter Monique Molina. Monique, thanks as always for joining us. First up, let's talk about Linde. Is Linde? Is that how you pronounce it? Linde?
Linde.
Linde.
Yes.
Okay, Linde. Let's talk about their into the gas, right? How are they doing?
Yes, so they're doing well today. Their shares are higher after analysts upgraded the stock, saying that they see more opportunities for the company in helium. That's one of the chemicals that this company produces. And helium prices have been rising with some of the supply for helium being in the Middle East and being impacted by the Iran war. The producers like Linde that are in North America are now having more demand for their products and are expected to see some earnings upside as a result now that they can charge more because of the higher demand. And we're also seeing some of their peers like Air Products and Chemicals also rising on these expected higher prices.
All right. And I remember hearing that we were going to run out of helium, and
Yes.
we still have helium. Well, we still have it.
Yeah.
Okay, going the other way, something that's a lot heavier, but worth a lot of money as well, aluminum and Alcoa.
Yes, so Alcoa, they are up today, also related to the Iran war. They were upgraded by analysts as aluminum prices have been rising. About 30% of the aluminum supplies are coming through either the Strait of Hormuz, from the Middle East, from different regions in the area. So as a result, there's been more demand for alumina, and this means that the domestic producers like Alcoa are going to see increased orders from customers, but this will cause earnings upside. But analysts are also noting that Alcoa needs energy in order to produce its product. And with the rise in energy prices, there is going to be some offset of those gains that they're going to see because they're dealing with higher input costs on their end while they're also able to sell their products at higher prices.
Nothing comes for free. Sable Offshore taking a hit today on a ruling.
Yes, so Sable Offshore, their shares are down this morning after a U.S. federal judge ruled that the Trump administration will have to provide all of the communications the government had in relation to Sable's pipeline in California. The administration ruled that the pipeline can be fast-tracked and now be put into production after being halted by the California government. But the U.S. judge found today that this process does appear to be rushed, so they have some more questions about that. And in the meantime, the pipeline is going to be on hold. So that's weighing on shares today.
All right, we'll wrap it up there. Monique, thanks as always, though, for joining us.
Thanks.
Bloomberg's Monique Molina. BYD, China's largest car manufacturer, says it is considering building a manufacturing plant in Canada. For more on this, we're joined by BNN Bloomberg's Lindsay Viscaya. Lindsay, thanks as always for joining us. The car industry in Canada is all over the place right now. Here's another twist.
Yeah, this is interesting. And I should start by saying that this is all from the chief VP, Stella Lee, in an interview with Bloomberg. She's basically dropping hints at this point. So nothing's set in stone. Nothing's confirmed yet. But she did say that the company is studying the Canadian market, looking for a potential manufacturing facility to, actually produce BYD vehicles here. Yeah. And BYD, obviously, a massive electric vehicle maker. It's top Tesla as having the most sales worldwide. So this is a company that's really taken off. No decision has been made yet. BYD did say they would own and operate a facility. There would be no joint venture, which could definitely be a problem here in Canada because right now the federal government has some mandates in place where companies would have to have a joint venture. BYD saying that would not happen at the moment. They're kind of like a standalone company doing things on their own. They want to keep it that way. So again, this is all kind of up for debate. We know BYD has applied for permits to actually export vehicles into Canada, along with 2 other Chinese electric vehicle makers at this point. Obviously now, since March 1st, Chinese electric vehicles, there. Exactly, they can come into Canada. But it would be really interesting to see how all of this plays out because the way we do things in Canada, in the auto sector, in the manufacturing sector, very different from how things are done in China. I know you were speaking with Greg Newman this morning about that and talking about whether this would work out. He was pretty skeptical. Here's more on what he had to say.
There's going to be many that argue, free market economists, myself included, I think, that it's a state assembly, and they don't really pay people a whole lot, and they throw all the resources and they subsidize it so they can come out with these cheaper cars and they can undercut the competition, and they're talking about maybe putting a plant here, Boyd plant here in Canada. I don't know how, because their model is to really not pay people, and in Canada we pay people a lot.
And also, of course, Newman bringing up like the regulations we have here when it comes to workforce and labor codes and also unions within that sector. So a lot of things to consider. I also reached out to Flavio Volpe just to get his opinion. And he was saying, the fact that BYD is coming forward saying no joint venture, that's not going to work here in Canada. So there's a lot of different hurdles that this company would have to jump through. Again, it's just preliminary talk, but it's interesting to look at it.
Okay. And I guess, there would be a market for it. Would they be able to stay that cheap, and would they be able to, I guess, go into the U.S. at that price?
Those are the big questions, right? Would they be able to stay that cheap? Would they be able to go into the market in the U.S.? The market in the U.S. is the real big question. Flavio Volpe brought that up too. The answer is we don't know how that would work. In terms of staying this cheap, like some of these vehicles, the BYD Seagull talked about quite a bit. If it was in the Canadian market, it would be the cheapest electric vehicle on the market. It would go for about 20 to 30,000 Canadian.
Wow.
But obviously the reason that Chinese electric vehicles are so cheap is a couple of different things. Like there's the wage gap in terms of the workers. Workers there,
wage gap.
Yeah, they get paid about like $5 an hour in the manufacturing plants. Here it's $30 to $45 an hour. They've also got this access to these critical minerals, right? China dominates that market. And also the Chinese government subsidizes a lot of these companies and really helps them out. So a lot of big questions here as to whether it would stay that way if they were actually manufacturing things here in Canada.
All right, Lindsay, thank you for that.
Thanks.
BNN Bloomberg's Lindsay Biscaya. Farmers are bracing for more price pressure as disruptions in the Strait of Hormuz continue. We'll have more market updates on that on the other side of the break. The Canadian economy lost the most jobs in more than 4 years last month, driving the unemployment rate up to 6.7%. StatsCan says employment fell by nearly 84,000 in February, with losses concentrated in full-time and private sector work. The job losses suggest the labor market remains soft as the economy bears the weight of U.S. tariffs and an upcoming review of the CUSMA trade agreement looming over businesses. The Trump administration has begun a second trade probe in a bid to replace IEEPA tariffs rejected by the Supreme Court. U.S. Trade Rep Jamieson Greer says the targets of this investigation include Canada, Mexico, the European Union, China, and the UK, among others. The investigations will determine whether acts and policies of each country related to the import of goods are discriminatory and burden or restrict U.S. commerce. Wheaton Precious Metals reported record 2025 revenue. It was up more than 80% year over year. It also saw a profit surge. The miner says earnings nearly tripled to just under $1.5 billion US, driven by higher gold and silver prices, as well as increased production of both metals. Wheaton also raised its dividend by 18%. And looking at the markets right now, it has been one of those days. The TSX off by about 0.3 right now, which is clawing its way back up. It was green to start, turned into the red, and still in the red is where we sit right now. U.S. markets, similar kind of wishy-washy kind of day. S&P 500 down by 0.2. Dow with about a wash right now. And the NASDAQ is off by about 0.45. Well, there is a growing concern for farmers and for your grocery bill. The war in Iran has disrupted fertilizer shipments through the Strait of Hormuz, a critical global trade route. With prices rising and supplies tightening, analysts warn the ripple effects could show up in U.S. fields and supermarkets soon. Joining us now is Josh Linville, Vice President of Fertilizer at StoneX Group. And Josh, thanks very much for joining us.
Thanks for having me.
Where are you sitting right now with what's unfolding in the Strait? What kind of an impact is it having for you?
Well, the best way to describe it is this has been the nightmare scenario for global fertilizer markets, and specifically nitrogen and phosphate markets. Nitrogen has seen the biggest impact with the Strait now being down for nearly the 2-week anniversary. Middle East urea values, we believe, are up substantially. We have seen NOLA urea, New Orleans, Louisiana, the most liquid market we have in the U.S. marketplace and the North American marketplace. Values are up about 40% in the last 2 weeks today. So that value, unfortunately, is going straight to the farm. The entire industry has had a very difficult approach to this growing season this year, 2026. And that's because the numbers have never made sense to lock anything in. So we've all been tepid. We've all been very conservative on approaching this thing. Less tons are already secured. And as these prices move up globally, everybody's having to play catch up. And those values are going higher in the inland country very, very quickly.
And what is there one particular area that's being hardest hit when it comes to fertilizer?
Right now, it's nitrogen. Specifically speaking, urea. It's the most traded product on earth for fertilizers. And the reason being, 3 of the world's biggest 10 exporters in the world sit behind the Strait of Hormuz. That's Iran, Saudi Arabia, and Qatar. But unfortunately, as this thing continues to drag on, we're now starting to see the tentacles of the story start to drag out and it's starting to bring other people in because of the lack of gas exports. Countries like India, one of the biggest manufacturers of urea in the world, is being impacted. Pakistan, somebody we don't even talk about very often, their production is starting to be impacted. And this is on top of European production rates being low. The Chinese government having entered 2026 saying we will not be exporting this year until at least August. If you had tried to make up a nightmare scenario for fertilizer in terms of where a situation happened and the time of year that it happens in, we're living that today.
So what happens? Will there be shortages? Could we possibly not see crops go in the ground, or are farmers going to have to, will they have something to actually buy no matter the price?
Fortunately, I feel like North America is in a pretty good spot from a nitrogen and a phosphate point of view. When you look at our import flows, whether that be what we know from the Commerce Department or what we believe is coming, we're actually in very good shape, presuming those tons still come here. There are still a lot of vessels pointed to the North American marketplace. They can be turned elsewhere around the world if they show a better netback, a better price. If those tons continue to come, what we need for April, May is very, very doable. But we are risking not only losing those tons coming in, but we could also see tons be exported at these kind of price differentials. I don't believe in North America we're going to be in a situation where we are going to have to switch crops because you can't find it. But the price is getting to a point where a lot of farmers are questioning, do I want to spend the money it takes to put this crop in the ground? Because while the fertilizer markets have been up substantially, we have not seen the grain market show anything close to the same bullish manner.
And I mean, for farmers, are they running the risk of going under? I mean, they're always walking a fine line at the best of times, a lot of them. Could this be even more adverse pressure?
I think it will be. I think those that have been struggling, this very well could be the final straw. If they had been dragging their feet, not purchasing that product ahead of time and getting in the field, if you are forced to step up and look at today's grain values and you look at today's fertilizer values, this might be the last straw for some of those farmers out there.
And do we know how this would translate to consumers? I mean, we're already looking at higher fuel prices, and now fertilizer is another part of the problem. Do we know what this might translate as prices at all? Can we even guess at that?
From a grocery store level, I don't think we're going to see anything just yet because we're not seeing it on the grain side. The markets have been very slow to respond to this because they're waiting to see. We've seen these types of cry wolf type stories before. Nobody's really wanting to jump up and down and be ahead of it. They want to see this actually play out. However, if this trade situation continues for a few more weeks, now we are going to start having these conversations of like, okay, who is going to bid the most for the few tons that are out in the world market? Now all of a sudden you're talking about some farmers going without, not getting as much application rate on those fields. Those yields start to get pulled lower. Now you start to see those grain values go up. Now you're going to start affecting those prices in the grocery store. It's going to take a little bit more time. It's going to be a little more sluggish, but it will reveal itself if this goes on much longer.
And can governments intervene? Is there anything they can do?
Unfortunately, no. In fact, we've been advising against governments playing a part because right now the prices are already high with the market doing the best that it can. If the government steps in, it is just going to superheat this entire situation and cause all the prices to go higher because instead of having to worry about, well, can that importer, can that retailer, can that farmer handle the price, they're now going to say, I know the Canadian government can handle the price. I know the United States government can handle that price. I can take my price up much higher, and I don't have to worry about pushback because they got money galore. It's nothing compared to this. So even if the government step in, I do think it superheats products. And frankly, it doesn't change anything. The global supply demand does not change because the government starts stepping in. Unfortunately, we're kind of in a grin and bear it type moment today.
Okay, let's just look at it. You mentioned if it continues on. How about tomorrow there's a miracle resolution, the strait is open again. What unfolds that way?
What we think, and again, this is all theoretical. We've never seen this in our history of our market. But what I currently think we'll see happen is you do see immediately prices tick down immediately. You're going to have some tired longs in the marketplace who are going to say, I want out of this market. I want to take my money and I want to run. That's going to cause some bearishness in this market, but it does not solve anything fundamentally. And I think that's where the prices start to go back to where they were. When you think about it, this system has been shut down for 2 weeks. If it opens tomorrow, to your point, you've got to get the vessels moving. That can happen in quick order, but you've got to get them sailing again. You've got to get the gas and oil fields back to operational. That's going to take time. Now you've got to get the nitrogen production plants in the Persian Gulf to restart. That's going to take some time. Then you've got to catch up the backlog of vessels. It takes a long time to load a vessel. Between parking it at the dock, opening it, filling it, closing it, pushing it off, you're talking at least a 2-day process. It's going to take a long time to get these vessels back into a flow that's normal. I mean, we are talking a situation, best case scenario, it is going to take weeks, if not months, to get back to normal. And unfortunately, when you think about it, it takes 30 days to get a vessel from the Persian Gulf over to the North American marketplace, just to our shores, not even inland. We're losing precious time that we don't have today.
Okay, we'll wrap it up there on that note. But Josh, thanks very much for joining us.
Thanks, sir.
Josh Linville is Vice President of Fertilizer at the StoneX Group. Coming up, we get more from the CEO of Wheaton Precious Metals on the company's record revenue in 2025. That's next. Vancouver-based Wheaton Precious Metals posted a record $2.31 billion for its 2025 fourth quarter revenue numbers, and it's attributing it to surging gold and silver prices along with higher production. We sat down earlier with Randy Smallwood, CEO of Wheaton Precious Metals, to talk about its latest earnings report.
Both gold and silver, of course, climbed to record highs through the year, and our production is continuing to grow. We've got a lot of new projects coming on stream. And I think these higher prices have actually driven a lot of growth at our partners' operations. And so really excited about where we are.
What is you're producing the equivalent of what in gold right now? Or what did you last year anyway?
Well, last year's overall production was just over 690,000 gold equivalent ounces, which beat guidance. I think our guidance was down around 640. And so beat our guidance healthily, a healthy bump on that. Mainly outperformance from Salobo, which is our flagship asset, but also from Peñasquito and even Constancia down in Peru. And so good, strong guidance. Of course, converted into the new GEOs, that was just over 800,000 ounces just because of the silver gold ratio changing.
Yeah.
And this year we're expecting to be somewhere around 900,000 ounces of production. So good, strong growth even this year. And as I said, climbing to 1.2 million gold equivalent ounces by 2030.
you and I talked about this a little while ago. Can you give us a ballpark estimate? How much of your cash flow is coming from silver now? Can you give us even a rough estimate?
Well, I mean, we were just under 40% silver and close to 60% gold in in 2025. Mm-hmm. Now, of course, we just did a slightly large acquisition with BHP in terms of a new silver stream down at Antamina. That'll kick us up. We're about even right now, but we've got a lot more growth on the gold side. The gold market is just substantially larger, and so we see a lot more opportunities in that space. So, I would predict sort of long term we'll always, by 2030, we'll probably be up around 70% gold, 30% silver. Some of that does, of course, have to do with how each metal performs. I am a bit more bullish on silver just because it's got better fundamentals behind it. But the size and the focus of gold is something to be respected in terms of how big that market is and where the demand is coming from. But I would sort of guide towards long term. We're going to be in the 70% gold, 30% silver range.
Do you get, when you sell your gold and silver, obviously your business model is buying it at a discount or obtaining it at a discount from your partners. Do you get pretty close to the actual spot price, or how does that work? Well,
actually, we've got a team that trades opportunistically, a metal sales team, and we traditionally beat the average spot price. I know we did really well in the fourth quarter just by holding on to some metal as we had that strong run and then pushing it out towards the end of the quarter. So it's one of the reasons that helped us do that. We've got a metals trading team that has definitely earned their salaries. They do a good job.
Do you ever stockpile gold thinking, it's going to go up a bit further?
I've been a long believer in the KISS principle. Keep it simple. We provide access to profitable precious metals production. We never carry a balance over a quarter. Every one of our shareholders has the opportunity to go out and buy physical gold and silver if they want to. As soon as I do it, I'm forcing them all to do that. I would much rather just keep our business model simple, focused purely on precious metals, focused on growth, top quality assets, profitable production at high margins, low risk.
And your yield now, I'm not sure, so you just announced a dividend increase, did you? My Bloomberg.
Yeah, that's right. Bumped up by 18%. We're now 19.5 cents per share per quarter. And, we intend to stay. I mean, we've committed to a progressive dividend, and we intend to stay near the top. I'm always proud of what percentage of cash that we actually do return to shareholders through that dividend. And so we intend to stay near the top of that in the entire precious metal space. Our shares have actually performed quite well. So the overall yield isn't super attractive. We're not getting sort of yield investors, but that isn't really our focus. Our focus is to be that foundation stock for everyone in the precious metal space. Everyone needs a little bit of gold in their portfolio. We should be that foundation stock.
So we just showed a one-year chart of you versus the TSX Global Gold Index, and you have been lagging, although you've caught up a bit lately. I think it looks as though investors were seeking more leverage over the past while, but certainly you have beaten the Global Gold Index, the stock index, over 5 years.
Yeah, I mean, there was a bit of a swing towards leverage last year as we saw a dramatic uptick in gold price and silver prices. But one of the concerns that I would say, and I think what we're seeing is a little bit of a shift back towards the streaming companies is costs have to chase that commodity price. It's just unnatural to have such a high margin between the gold cost curve around the world and the actual spot price itself. And so that lower grade material is going to work its way into the mills. We're going to see inflationary pressures. All the oil issues that we're having, an increase in oil costs, diesel costs, going to have an impact. And so I think what we're going to see is probably, I think this year we're going to start to see a shift back, because I really do think that costs are going to be a ever increasing challenge for the actual mine producers themselves, the mining companies themselves. Of course, the strong beauty of the streaming model is there is no cost risk exposure. You don't get the inflationary pressure that the mining companies will suffer from.
I know governments can read the papers. They can see the way the gold price has gone, and they are tending to seek a bigger take. I know Ghana, a major producer in West Africa, is now talking about revising royalties.
Yeah, it's one of the reasons why we really put a lot of focus on staying in the first and second quartile. 83% of our production, actually, I think it's 85 now, percent of our production now comes from first and second quartile assets. These are assets that are profitable enough that, you know, every stakeholder will get, you know, a good share out of it. Everyone's happy. And so it's such an important aspect of making sure that we invest wisely. You know, it's really the first question we ask whenever we're looking at opportunities is which quartile does this asset fall into? Because we want to have healthy margins all the way around the table.
And he was speaking with Randy Smallwood, CEO of Wheaton Precious Metals. Coming up, we'll check in on the markets on Bay and Wall Street. The Prime Minister has a new plan to defend, build, and transform the North that involves $35 billion. Mark Carney making the announcement in Yellowknife, but there are questions about when he can deliver. CTV's senior correspondent Judy Trin has more.
The Prime Minister has grand ambitions for Canada's Arctic.
We're taking full responsibility for defending our sovereignty, and we are unleashing a range of new economic opportunities.
It begins with modernizing military air bases. The money was earmarked 4 years ago under the Trudeau government, but only now are the plans taking flight.
They lacked the scale of ambition and the depth of strategy worthy of this vast region.
It includes $32 billion to expand air bases in Yellowknife, Inuvik, Iqaluit, and Happy Valley Goose Bay, and $2.6 billion to build new support hubs in Whitehorse and Resolute, and smaller facilities in Cambridge Bay and Rankin Inlet. There's also money to upgrade the Rankin Inlet Airport and improve the runway in Inuvik. Carney also wants to better connect the North, referring several projects to the Major Projects Office for fast-tracking, including the Mackenzie Valley Highway, the Grays Bay Road that connects to a deepwater port, and the expansion of the Tallston Hydro Project to serve 70% of residents in the Northwest Territories.
With this plan, we are taking control of our future.
The Major Projects Office, which was created last August, has yet to approve a single project. And while construction contracts have gone out to tender, the vast majority of funds to improve air bases has yet to start flowing. Judy Trin, CTV News, Yellowknife.
And it's already been a year since U.S. President Donald Trump slapped those punishing 25% tariffs on steel and aluminum. They would later jump to 50%. At least one company has posted near $1 billion in losses. CTV's Andy Bergeron-Oliver looks at how the steel industry is doing 12 months on.
Ottawa's Ambico Limited sells 75% of its steel doors to the United States, a country that 1 year ago implemented heavy tariffs that reshaped North American trade.
We probably suffered in the vicinity of $500,000 of cash that we've had to pay unexpectedly. So that hurts.
Since the U.S. president initially slapped a 25% tariff on steel and aluminum products, costs have skyrocketed. Confidence from American customers has plummeted, and predictability, especially with CUSMA negotiations ongoing, has evaporated.
So we have a lot of variables that we build into our cost structure. Tariffs is a major concern if the CUSMA agreements fall by the wayside.
Ambico is lucky. Their manufactured products are CUSMA compliant and not subject to the Section 232 tariffs that are crushing primary steel producers like Ontario's Algoma Steel. Last quarter alone, Algoma Steel saw steel shipments drop 31% and reported a net loss of $364.7 million, driven largely by tariffs.
It's an illustrative example of the pain that the industry's been going through as we try to, unravel, if you will, 30 years of integration with the United States.
The industry is desperate for tariffs to be lifted and hopes ongoing CUSMA negotiations will do that. But today, the minister leading the review refused to take questions, and the industry minister offered no update.
What kind of update can you give us? When it comes to steel, our goal right now is to make sure that we help our steel workers. That's what we've been doing.
The association representing primary steel producers says it will take a long time to undo the damage caused by 1 year of steel tariffs. Annie Bergeron-Oliver, CTV News, Ottawa.
Market Call is coming up next. Today on the show, we have Tony Sierro. He is the Vice President and Senior Portfolio Manager at Caldwell Securities, and we'll be taking your questions on North American large caps. And let's take a look at see how the markets are doing right now. We're not going to like it. Bay Street, it is off by 0.6% right now, taking a hit. Just a couple of groups worth noting. Inch House is off. What's it off now? Let's see that. It's down 11% on its latest report. Fell as the company's recurring revenue base shrunk in its first quarter. Weaker license sales there is putting pressure on the profit. And the shares are down. The Canadian software company reported a 3.1% decline in revenue to $120.1 million. So they're taking it off. They're having a rough day today. And one other one that's taking a hit right now is just looking at or actually going the other way. I just want to bring it up for a second. Go Easy, which has been hammered this week on its earnings report and was down, I think, close to 80%, is now on a little bit of a ride. It's up almost 18% right now. And maybe people buying the dip, a very big dip, or it's a dead cat bounce. We'll have to wait and see. Let's head over to Wall Street and see what Wall Street is doing right now. And same situation, mostly in the red there. The S&P 500 off, and the Dow down, and the NASDAQ as well, off by 0.75 point. One of the ones taking a hit today quickly is Adobe on the news of their CEO leaving. It's off by about 6%. It's already been a rough ride for them. And that is it for Morning Markets. Thanks for watching. We'll see you back here on Monday. Have yourself a great week.